Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast. With Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, well, tech, as you can see, trades lower as AI anxiety kicks off the last full trading week of the year. Are investors doubling down or bracing for a pop? We discuss. Plus, big deals in big tech with ServiceNow and Intel in advanced talks to spend billions on startups. And a stablecoin giant wants a soccer team? Why Tether is bidding more than $1 billion for Italy's Juventus. But first, a check-in on these markets. We want to talk soccer, but we're talking what the markets are up to, under pressure by 0.25% on the Nasdaq 100. As you see, we're off of our lows of the day, but still in the last full trading week, ahead of the end of the year, are people taking some risk off the table? They're certainly taking risk off in the crypto space. We're down sub 90,000 once again, 86,924. We're off by another couple of percentage points after a downdraft over the course of the weekend. So the moon music, again, speaking to AI anxiety, speaking to some nervousness around valuation, is today's picture. But take a look at some of the individual names. ServiceNow is off by more than 10%, as maybe we still see companies spending in terms of M&A. There is ServiceNow potentially in talks to buy cybersecurity unicorn Armis, being reported over the course of the weekend. Could value at about $7 billion. That would be the biggest ever deal for ServiceNow if these reports come true from Bloomberg. And indeed, we could see it just delving ever more deeply into cybersecurity. Intel off by 0.5% as it too is in advanced talks, we understand, to buy an AI chip startup. That's SambaNova Systems for about $1.6 billion. And Tesla at a record high. Will we close this day at the first record for Tesla since December 2024? The catalysts, well, Wedbush going more overweight on the stock once again. But other than that, no clear fundamental driver. That is what we're looking at on the day. Let's look at just the course of ChatGPT. And since 2022, I want to show you the growth of the Nasdaq 100. Phenomenal, up more than 100 percentage points. It's more than doubled, of course. But doubts about the AI trade, they're starting to grow too now. Bloomberg's market reporter, Ryan Vlastelica, can set us up for what the end of this week anxiety is saying about the belief in this 100% rally since November 2022, since ChatGPT first burst onto the scene, Ryan. We are having yet more and more concerns about the valuations and the run-up in certain companies.
Hey, good morning. Thanks for having me. So yeah, a lot of these concerns have been just sort of percolating throughout the market. And every so often we'll see them sort of, emerge and go to the forefront. That is sort of what we're seeing right now. It does seem like there is a lot more skepticism, a lot more caution about valuations, about growth prospects, about when we are going to start seeing a more pronounced return on all of this AI spending. And maybe just because it's sort of like the end of the year, people are looking to close out their books. Maybe people are taking a reassessment right now of all the big gains that we've seen in a number of AI stocks and just sort of considering where they might be going in 2026.
I mean, there really is some of the most read stories throughout the course of the weekend, and indeed on this day is the one that Wall Street sees AI bubble coming and is betting on when it pops, if indeed it does. The eye of the storm have been companies like Oracle, even Nvidia, which has been the pin-up for this year and still remains so in terms of a 12-month trading basis, but of late has taken a hit to market capitalization. Are there any particular areas that we're seeing the most pain, Ryan?
Well, one interesting theme that we wrote about, I think about a week ago, is sort of the constellation of stocks that are more associated with OpenAI as opposed to the ones that are more associated with Alphabet. And for much of this year, any company connected with OpenAI saw pretty strong stock gains. A lot of companies rallied when they would announce deals with the company, with the startup. And now we are really seeing that reverse. There's a lot more skepticism about, is OpenAI going to be able to grow fast enough in order to meet all of these sort of deals and obligations that it's announced? As skepticism around that has grown, you have seen companies connected to OpenAI start to really come under pretty pronounced weakness. You mentioned Oracle, but also, in a sense, Microsoft, NVIDIA, CoreWeave, companies like this, whereas companies that are more connected to Alphabet and Gemini, which is currently seen as sort of the stronger AI play, those companies have been continuing to hold up in a lot better fashion.
Ryan Vlastelica, you're continuing to write upon all of these themes as we tie up 2025. Fantastic to have you kick off the show. We thank you. Let's keep this discussion going. Let's delve a little bit deeper into the signals in the economy, what that's doing in terms of trickling into business. Natalie Gallagher's with us, principal economist and director at Board. Now, that's an AI-powered enterprise planning platform. You provide macro analysis, you provide strategic guidance to global companies on business investment, on economic policy. And what's really interesting is you're sort of telling us and pointing towards your expertise, showing that 2026 is really going to be a prove to me moment, right? For 2025, it's been about picks and shovels and infrastructure. 2026, we need the economic upside. We need the productivity gains.
Yeah, absolutely. I mean, so far, right, we've had really broad-based adoption of AI. About 55% of American workers, for example, say that they're utilizing AI. We haven't seen it translate into the productivity numbers, right? And this isn't just with the government data, it's also with private studies as well and university studies as well. So as we get into 2026 to really validate the underlying fundamentals, we're not only going to have to see that breadth, we're going to have to see really meaningful depth of adoption as well.
Natalie, when you're poring over the data, what is the data that we're going to need? Is it going to be the earnings of healthcare companies and financial institutions that actually start to see margin improvement because of AI adoption? How do you get that tell?
Yeah, absolutely. I mean, the first place we'll probably see it is in earnings release, right? The government data often lags behind. You know, we've seen a lot of earnings releases where CEOs have said, hey, we're utilizing AI, we're seeing these productivity gains. At the same time, we're not seeing them show up in as meaningfully as a way as we're going to need to really justify the valuations that are out there, and really confirm, right, that we are seeing that productivity growth or that return on the transformational promise of AI.
What we have seen show up is the AI investment numbers driving GDP figures. Many would say that basically 2025's economic growth entirely hinges on a few big names in tech making some extraordinary big investment plans. How wide could the economic shakeout be if indeed we did see a pullback and a questioning of productivity?
Yeah, I mean, it could be really significant, right? 2025, AI spending, CapEx spending, it's really served as a macroeconomic stabilizer, a macroeconomic anchor, even as we've seen other parts of the economy really meaningfully stagnate, right? It's really been this promise that's continued to lead growth to not only deliver, but really surpass expectations in 2025. And that's definitely true, right? It continues to be an anchor in 2026. So if we see a meaningful pullback, if we see AI not deliver and sort of that translate or cascade through the economy, I mean, the economic implications are really, really broad-based, well outside of tech.
How broad-based do you think the economic implications have been of China and US and this technology war, really, we're seeing at the heart of it? How much has that implicated US businesses and in the longer term, do you think?
It's been fascinating, right? Because U.S. businesses, even with sort of this headwind of overall trade uncertainty, this back and forth with China, they've really continued to deliver, and so that's really positive to see. You know, on the other hand, right, if we do get more and more decoupling with China, the economic implications are also broad-based there as well. We have a reduction in revenue, translates to a reduction in R&D, and so, of course, the economic implications, based on what direction we take, can be they can be quite extensive. Now, at the same time, if it leads to sort of a benefit when we look at the competition dynamics, then maybe it's a little bit of a win-win for the U.S.
What's interesting is while we've got perhaps a questioning of valuations in the market, some still manage to rise on absolutely no fundamentals at all. And Tesla is currently maybe closing in yet a new record high, the first one we've seen since December 2024. Now, maybe that's a bit of moon music coming from an extraordinary valuation being given to the private company that is SpaceX elsewhere in Elon Musk's realm. Natalie, what do you think about some of the froth in the areas, particularly in the private area?
It's been really interesting to see, right? Whenever, you know, as an economist, what I look at is cash yields, right? And whenever we end a rate cut cycle or, you know, debatably end a rate cut cycle like we are right now, cash yields become less attractive. And what we need to really carefully watch is, are we seeing meaningful investment in actual infrastructure? And that's what's really driving these extremely high elevated valuations, or are we seeing investors go towards alternative investments because cash yields are quite impacted? And so we're going to really need to see these valuations be meaningful, right? We're going to need to see that the proof is in the pudding.
That it is worth $800 billion. Natalie Gallagher with the macro and the micro for us. We so appreciate it. Principal economist at the board. Now coming up, Juventus shares. Have you been watching them? They are rallying after Exor rejected an unsolicited takeover bid from crypto giant Tether. We dig into that one. Plus, Netflix makes its case for Warner Brothers after Paramount, of course, goes public with its own hostile offer. What did the co-CEOs manage to say? This is Bloomberg Tech. Shares of Italian football club, Juventus. You might call it a soccer club. I call it football. Well, they jumped after crypto company Tether made a takeover bid for 1.1 billion euros, about $1.3 billion. Now, the offer was swiftly rejected by the holding company of the Agnelli family, which owns a controlling stake in what is one of Italy's most distinguished football clubs. Let's get more on all of this. A Bloomberg editor in Milan, Tommaso Ebhardt. Fascinating. This family, the Agnelli family, have held a controlling stake for years in this team and indeed own Ferrari and other big auto sectors. But Tommaso, what does Tether have in terms of its game plan?
It's a very fascinating story here from Italy. You know, it's like new money versus old money. Interesting enough, Tether founders are originally from Turin, the city where Juventus was born, and they support Juventus. So they started as a fan, and Ardoino, the CEO of Tether, told us in an interview a few months ago that he has been a fan of Juventus forever. And Tether bought a 10% stake in Juventus a few months ago. It was the first football team where a Keep Crypto company bought a significant stake. They also have a board seat in Juventus, and now they arrive with a bid Friday night for the controlling stake to the Agnelli family, Italy's most important industrial clan. But the Agnelli family said, no way. We're not going to sell to Tether. We're not going to sell to anyone Juventus. They've held Juventus for over a century. So far, no news, but shares move. They didn't get up to the level of the price offered to the Agnelli, but they rose more than 14% today in the Italian market in a very difficult moment on the pitch for Juventus. They're not doing that great this year.
Yet, is that the argument coming from these lifelong fans at Tether that they could in some way manage the business of football or soccer better?
That's a good question. For sure, they have a lot of cash, and in the bid, they said we're also ready to invest 1 billion euros in Juventus, but this is not enough for the Agnellis. Saturday afternoon, John Elkann made a video. John Elkann is the leader of the Agnelli family nowadays. Made a video online saying, you know, we have defended the Juventus value for over a century. We want to stay close to Juventus. We've been with Juventus in the bad and in the good times, and we'll stick with that. Interesting enough, is a very delicate and sensitive moment for the Agnelli family. Why? Because they are reshaping their portfolio. You know, they're the biggest investor in Stellantis. The automotive industry is facing a disruptive moment. The Agnelli have sold some assets recently, including their truck company Iveco to Tata in India. They are now in talks to sell the media asset in Italy to a Greek company. So there's a lot of interest and also a lot of political debate on what the Agnelli families are doing with their Italian holdings.
Yeah, some pushback against Greece's Antenna Group for wanting to have that Italian asset. Meanwhile, Tether's been investing in plenty of Italian assets. It looks like more across the board, whether it's genomics companies or even in media companies as well. Tommaso, it's so great catching up with you. Thanks for staying a little bit late in Italy. Tommaso Ebhardt there from Milan. Look, let's pivot into a different world of entertainment now. The co-CEOs of Netflix. They've been making their case for acquiring Warner Brothers Discovery to their own employees. Let's get the latest with Bloomberg's entertainment editor, Lucas Shaw, who's been across this M&A story that is just fueling everyone's attention in Hollywood at the moment. So what is it that the co-CEOs could put across their employees to calm their own nerves?
It was a Q&A of sorts. They first of all stated their rationale for doing the deal, and then tried to address some of the 5, 6, 7 biggest questions that there are out there. Is this going to kill Hollywood? What do they think of the Paramount hostile bid? Do they actually think they can get this deal approved? And the kind of the big one about movie theaters. It was as much for the public, I think, as employees. They put it in a filing so that the world could see it. They've obviously been keeping their employees apprised to the best of their ability over the last couple of weeks. And the ones I've spoken with have said it's been pretty status quo at the company.
Meanwhile, of course, what we all wait for in the entertainment world on a Sunday is your note to drop of screen time. And Lucas, you've been writing in particular about, amid all of this fury about concern about consolidation in the sector, it's also AI, which is looming large in many executives' head and employees. What do you make of the AI threat right now?
Well, Hollywood is very conflicted. You see certain filmmakers come out and say, I've interviewed a couple of them, and say it's the future. We might as well figure out how to use it and integrate it into our workflow. And then there are others like Guillermo del Toro and Ryan Johnson, who've basically said they'd rather die than use AI, or that they will do anything that they can to stop it. You saw a very strong negative reaction last week when Disney announced a deal with OpenAI, where a lot of the unions and a lot of workers wondered what the company was doing.
Well, reading it with interest, it's also featured in Business Week's The Year Ahead for 2026. Go look at it. Grapple with the future of Hollywood. All things AI from Lucas Shaw. Thank you very much for keeping us up to speed. Meanwhile, President Donald Trump's new $100,000 fee on H-1B hires, well, it's set to deliver the biggest blow to IT outsourcing and staffing companies. According to analysis done by Bloomberg, businesses like Tata Consultancy Services and Infosys, they're likely to be hit harder than, say, US tech giants like Amazon and Google, but still all impacted. Let's dig into the broader impact with Hiba Anver. She is a partner at Ericsson Immigration Group, working round the clock on issues such as this, I'm sure. And the context is companies that take the financial hit, but also states that try to push back on it. And the latest is that we understand a group of states are actually suing to block this in particular. Do you think that that's going to gain any traction?
I do think that it's going to gain traction because what the states are doing that's different than some of the lawsuits that have already been filed is they're making a legal argument based on their specific state economies, which I think is a really important argument because it goes directly against the claim that a lot of opponents to the H-1B visa have, that the H-1B visa is actually harmful for the U.S. economy. The lawsuit that was filed by California and the 19 additional states essentially argues that this $100,000 fee is going to worsen labor shortages within other important sectors that exist within the state economy by making it more difficult to fill spots for occupations that are already experiencing shortages, such as physicians or researchers or teachers, nurses, for example. And so I think that this lawsuit puts states in a position where they can actually show harm in a way that's more effective than some of the lawsuits that have already been filed.
Their argument is that no presidential administration can rewrite immigration law, is what they're taking. And I think it's the third challenge, at least, that we've seen to this particular fee increase. But on the flip side, the president and the administration would say we need this fee because H-1B is being abused. What evidence is there for that, from your perspective, Hiba?
I think the more important evidence is when you take a look at the H-1B filing process in and of itself, it actually has several checks and balances that are already built in to ensure that the H-1B visa is not being abused or misused in any way. And in particular, one of the core components of filing an H-1B visa is to be able to demonstrate back to the government that the filing of this visa is not going to displace a qualified U.S. worker. So I think that what's more important to focus on are the checks and balances and the safeguards that are already in place for the H-1B visa to prevent the fraud and misuse, because the highly restrictive policies for folks that are actually proponents of the H-1B visa create a new category of risk, which is that this is actually going to hamper and diminish the American innovation and the U.S. companies leading the charge on global innovation.
Now, we take it to another extreme. And what's interesting is there's actually blowback, not coming from Democrat states who are suing, but actually conservative lawmakers who are saying that in some ways Trump is supporting yet more legal migration and immigration into the country. They're criticizing President Trump for supporting more visas in particular to allow the entry of high-skilled foreign workers. Is there any mounting further around this that you're hearing, Hiba, or something that companies are worried about, that names like Republican Chip Roy would actually manage to prevent legal immigration at this time?
I think, I think that the concern in the industry is more so based on the data. I think that we're far out enough from the beginning of the year to be able to actually measure the data in an effective way. And I think that what we're starting to see is U.S. companies starting to grapple with the decision about whether they want to continue to invest in other countries where the talent, the high-skilled workers in particular, are more inclined to go. As opposed to, the talent that may be a little bit more concerned about staying here in the U.S. So said another way, I think the concern in the industry is whether some of these larger companies are going to choose to offshore, for example. And another really important component of this is a lot of the folks in the industry are actually specifically watching how other countries are responding to some of these more restrictive immigration policies, namely, China and Canada being some top examples. For example, China recently released the K visa for global tech talent, which is specifically aimed at attracting international tech workers. And that was done in direct response to the U.S. tightening its immigration policies and this new $100,000 fee. So what I think the concern is here is whether the talent is going to be incentivized to choose another country, whether other countries are going to be more inclined to have more open immigration policies in an effort to try to attract that high-skilled talent, and what that eventually means for the global success of U.S. companies.
We've got 30 seconds. Is it big companies that hurt the most here, Hiba, or is it smaller ones?
So it's usually the larger tech companies in particular that garner the most attention. But, it's also important to point out that when it came to first-time H-1B visa petitions for new employment in fiscal year 2025, over 28,000 companies filed at least one. And so what that data implies is that the companies that are benefiting from H-1B visas are actually, very diverse in terms of profile.
Leave it there, Hiba. We thank you very much, Hiba Anwar from Ericsson Immigration. But let's talk more broadly about the world of technology and how it's implicated by, geopolitics. China, in fact, has just started to grant licenses with lengthier terms that would allow European companies to obtain critical rare earths. That's all according to EU top trade official Maros Sefcovic. Bloomberg's Oliver Crook sat down with him earlier today. Just take a listen.
I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
What does this mean about global access to rare earths? We can talk about that with Bloomberg senior tech editor Mike Shepard, because this is a fascinating read across to the US. Brussels had been really worried about a choke point, bottlenecks brewing, that would implicate to such a degree vital industries, the German car makers. But similarly, those choke points and bottlenecks are here in the United States too.
Well, that's right, Carol. There are so few points of common ground when it comes to trade for the EU and the U.S. these days. But access to rare earths actually happens to be an area where they share this concern. And that is because each side, they see their companies, their economies so dependent on China for access to these critical inputs to all sorts of technology. It is not just the advanced tech that we talk about so much on this program, semiconductors and other things. It also goes into defense equipment, into automobiles, into solar arrays, really into a little bit of everything. And China owns the lion's share of not only the deposits, but also the refining and production of it. So for the EU to say that it is seeing some glimmers of hope in being able to access these rare earths on a wider basis signals perhaps some progress, Caro, in this nearly year-long fight with China over access to these critical minerals.
Bring us up to speed on that fight and the access? Because I think it was just last month in November that President Trump and Xi Jinping came to some agreement around access to rare earth metals and materials, but they're still dependent on this April licensing agreement, right?
Well, absolutely. And what we're hearing from Aris Sefcovic is that the Chinese may be more inclined to grant what are called general licenses. And this is a key word that he used in that interview. It's not just a license for a one-time shipment of a critical mineral, let's say gallium or something else used in night vision goggles or something along those lines. It's a general license that would allow for a longer period of time for repeated shipments to pre-approved buyers. And that would really speed the plow for companies in the European Union and the U.S. And this is what both sides have been agitating for from China. And it's a key part of the trade truce that was reached between President Donald Trump and Xi Jinping at the end of October. It took effect in November. And it is really something that U.S. officials are watching closely from. And they will be hearing from U.S. industries, especially the auto industry, which has expressed the most concern over Beijing's control over this and the bottleneck that they really began to see in April when authorities in China began to tighten the export controls there. So we'll be watching to see what the signaling is from U.S. trade officials and whether they're seeing similar signs of progress.
Bloomberg's Mike Shepard, we always appreciate you. Thank you very much indeed. Now, talking of bottlenecks, surging electricity demand, driven in many ways by AI data centers, is highlighting the need for more power in the United States and indeed globally. There's some good news on the tap in 2026. The nuclear industry is poised to turn on 15 reactors worldwide, but that's actually after a drop in capacity this year. Let's break it down with Bloomberg's Will Wade, covering energy, climate, and all things nuclear. Will, I'm surprised the talk, the hype has been there in 2025, but not the reality. There's actually been less nuclear capacity.
Yeah, we're going to lose about a gigawatt of nuclear capacity worldwide this year. We're going to have 2 reactors that came online and 7 older ones got shut down in different parts of the world. I think the quote that I've heard this year from one of my sources that sums it up the best is like, everything's happening and nothing's happening. Because the thing about nuclear, and my editors, it drives them crazy. It happens really, really, really slowly. So there are 62 reactors under construction worldwide around the world. They're going to start coming on in big waves next year. We're going to get like 10 gigawatts of capacity next year, 10 more the year after that, close to 10 the year after that. So there's a lot coming, but there's not a lot coming on right now.
Just how important is the actual sourcing of power, the idea of nuclear being that energy and climate friendly version of so doing, particularly plugging into data centers? Or at the same time, is electricity and the needs of it being hampered by just resiliency in the grid? There's a great story out by your colleagues today, another 5th story on bottlenecks, really looking at a series of obstacles slowing down the transition to a cleaner, more electrified future. And they're really signaling out the issues that we face in terms of just the electric grid and inexperience and congestion there.
Yeah, the grid is another huge issue all to itself. The ability to deliver the electricity is, what happens with the grid, and connecting to the grid takes years. You have to go through all kinds of permitting. So you can plan your nuclear power plant, and it still takes years to get a connection to it. We're going to have 3 Mile Island come back into service in 2027. That's actually a year ahead of schedule, and it was supposed to be 2028, but they managed to get a grid connection sooner. The work to get it ready was always going to take until 2027, but they managed to get the local grid to hook that up earlier, so that's going to come faster. But grid connections are a big bottleneck, not just for nuclear, for any new electricity.
Well put, Will Wade. Great analysis. Thanks for talking us through it on all things nuclear and more broadly energy adoption. Now coming up, we're going to be discussing the future of drug discovery, powered by AI. We're discussing it with Chai Discoveries, Josh Meyer, and Elena Weibach of General Catalyst. There's a new funding round. It's making a unicorn. This is Bloomberg Tech. Chai Discovery. It's an AI drug discovery company backed previously by OpenAI, and it's just raised another $130 million to scale compute, to scale talent. The goal? To build a, quote, computer-aided design suite for molecules. Chai Discovery co-founder Josh Meyer joins us now, along with Elena Wiebok, who is General Catalyst Managing Director. You co-led the round with Oak HCFT. So I go to you first, Josh. Congratulations. This is just 3 months after you did a Series A. Why are you doubling down, and what is the money being used for?
Well, first of all, thanks so much for having us here. It's a really exciting time for the company. We're coming out of this year with a series of research breakthroughs where we've now shown that we can use AI to design molecules that we never even thought was going to be possible. So we're really using this money to double down on that research agenda. The models show no signs of slowing down. And then also really growing the team and starting to take these models and start deploying them really at scale and starting to create new molecules that, again, we never thought would have been possible to create.
Elena, it feels like this is a relatively pivotal moment in AI's push forward on drug discovery and on healthcare more broadly. You're someone who invests in life sciences. What is it that made Chai stand out, that you thought it needed follow-on money just 3 months after a Series A?
Absolutely. So Chai stood out because 2025 was the year of AI discovery. And what Chai allows you to do is understand and predict the interaction between molecules to design and develop new medicines. And the reason we invested now is because we believe 2026 will be the year of deployment, and pharmaceutical companies that adopt this technology will absolutely leapfrog those who do not. And it's a moment where medicines that could not be discovered any other way will now be discoverable.
And the aha moment, in many ways, was following the release of Chai 2, Josh. Just tell us why that was so important, the latest antibody generation model that you released and I'm sure suddenly had a load of inbound calls on the back of.
Yeah, so of course this is our Series B, but if you look back at our Series A, we told our investors that over the next 2 years or so, we would try to reach a 1% success rate on this antibody design task, meaning that 1% of the molecules coming out of our models would function in the lab. We thought that'd be a breakthrough moment of the field. But a couple months ago with Chai 2, we actually announced that we could do this with about a 15 to 20% success rate. So I think really leapfrogging again what even we thought was achievable in the past year or so. So that's really been, I think, a big moment for the field. And now moving us away from just research curiosities into models that are really useful for actually discovering drugs.
Elena, that's sort of mind-blowing for many who aren't in the weeds on life sciences as much as you are, that there is only a 1% hit rate was going to be really tangible for the field, and let alone 15 to 20%. Talk to us about what have been the limitations thus far in drug discovery, in labs for pharmaceuticals, and what this changes in terms of AI.
Absolutely. So when researchers try to make a new model, a new molecule, it's essentially searching for a needle in the haystack. It happens in a lab. There's a lot of variability, and it's really challenging. That's why even though we've seen breakthrough medicines and many people benefit from them, there are still lots of areas where people get sick and have no options. What Chai has done is show that they can design computationally medicines that have over an 85% success rate in achieving basic drug-like properties. There's additional research to do, work to be done that takes a drug from the computer into the lab, into people, into clinical trials. But there's been a long-standing hype around AI for drug discovery. And now when we meet pharmaceutical executives and they meet Chai, everyone says, this is the year of deployment. Now these models work in a way that they will actually contribute to new medicines that make it to patients.
And of course, Josh, you've previously been backed by Thrive Capital, Menlo Ventures, OpenAI has been a strategic investor and a place you used to work. But with General Catalyst and with Oak on side, I'm sure those meetings with pharmaceuticals come more thick and fast. But what more is the money being put towards when you talk about scaling this project? How much compute do you need? And how much you need to invest in GPUs as well as the engineers and the fierce talent wars to get the right people in the door to build the models too?
Yeah, well, I'm thrilled to be working with General Catalyst and Oak here. You know, this round is actually about a lot more than the money. you bring together some of the top investors in this space in healthcare. If you look at the folks joining our board, Annie Lamont and Hemant Naja. These are investors who have been Midas-less healthcare investors, really plugged into the pharma space. We're here with Elena as well, who's just such an incredible thought partner on really building out the business. So the capital is going to work among all the things that you mentioned. We're really putting an astronomical amount of these costs into compute. We're trying to turn compute into better molecules. We run a ton of lab experiments to really test whether the models work in the real world. And we're doing a lot as well in order to start deploying these models, building the right kind of software tooling in order to build this computer-aided design suite for molecules. There's the talent wars as well. I'm very, very grateful to be working with some of the top folks in the industry here. When we started the company, we actually brought together a number of heads of AI from top AI drug discovery companies, and we've only continued to build out an exceptional team here. We're a small but mighty team, but we're really putting this to work in order to turn science from biology from a scientific discipline into one that looks a little bit more akin to engineering.
Yeah, Elena, you said a great line that basically there's been a lot of hype around AI and how it will be applied to healthcare. But what do you think helps cut through to those who are laymen to a lot of the real details and data being shown in this, that we will see productivity gains, we will see real deployment in 2026? What's your hope as to what this looks like next year?
Well, I think for next year, the hope, and I think pretty strongly the reality, is that pharmaceutical companies will be able to discover medicines more efficiently. So Josh mentioned there's a lot of compute going in. That's really on the research side. What's incredible is this technology is efficient. It is helping people discover medicines. And to me, the most important thing that lay people will see is when we use these tools, we can discover medicines that take advantage of known biology and impossible chemistry. You could not make the molecule, you could not make the medicine without using this technology. And what people will see are medicines that are curative that would not have been discovered any other way. And that's where lay people will really see the benefit, is in medicines that have impact on their lives.
Chai Discovery investor Elena Vibok there from General Catalyst, and Chai Discovery co-founder Josh Meyer. It's been great speaking with you both. Thank you very much indeed for joining today. Now coming up, take a look at the shares of ServiceNow and Intel, both under pressure, both in talks to buy startups. We'll talk about those potential deals next. This is Bloomberg Tech. It's time now for Talking Tech, and first up, Roomba maker iRobot, of course, is filed for bankruptcy and proposed handing over control its main Chinese supplier, Shenzhen Robotics. Under the proposed Chapter 11 plan, the company's common stock will be wiped out. Plus, leadership at McKinsey is discussing potential job cuts, reducing roughly 10% of its headcount across non-client-facing departments. This coming as its revenue growth has flatlined over the past 5 years. Now, a McKinsey spokesman said that we are operating in a moment shaped by rapid advances in AI that are transforming business and society. And ServiceNow, well, it's closing in on a deal to buy cybersecurity startup Armis for as much as $7 billion, according to people familiar with the talks. Now, the stock is under pressure, as you can see, after analysts at KeyBank cut their rating to underweight this morning, citing mounting threats also from artificial intelligence. Let's just dig in on that particular deal, on the talks, on ServiceNow, but also other deals being eyed in tech, including Intel's potential plans to buy AI startup SambaNova Systems. Joining us to discuss all of this is Bloomberg's Ryan Gould, covering M&A, and as ever, a busy weekend for you covering M&A, Ryan. Talk about ServiceNow first and foremost. Why does it want this Israeli-based cyber company, Armis? What would it help it do?
Thanks, Caroline. I think it's an interesting time to be ServiceNow. You'll note that they announced earlier this month an acquisition for a company called Veza, or Vetza, depending on how it's pronounced. I think that was worth about $1 billion for the security and risk portfolio. I think this really drives home the idea that you need to be ready for an enterprise the size of ServiceNow for potential threats, potential attacks, in the age of AI. This is a massive growth area across the street. You've seen quite a few other sizable cyber deals this year, including CyberArk being bought by Palo Alto Networks. Big enterprises, Microsoft, Google, I mean, look at Google Wiz paying $32 billion for what is ostensibly a threat detection and enterprise management business as one of the biggest M&A deals of 2025. So I think this is really driving home the point that AI and security go hand in hand.
They go hand in hand. And also AI is fueling M&A in other parts of the industry. I mean, Intel, Lip-Bu Tan, the CEO of Intel, is also on the board of a startup that you report might be being eyed as well by the company.
That's correct. I think this acquisition would be seen as Lip-Bu Tan sort of doing a full circle ride almost. Lip-Bu Tan, the CEO of Intel, was at one point the executive chair of SambaNova. His VC fund, Walden International, was one of the founding investors of SambaNova. SambaNova makes custom AI chips, the type which, if all were to go well, could potentially rival NVIDIA and AMD in that market space. For Intel to get a hold of this, I think this would be seen as Lip-Bu Tan, really putting Intel in the mix in AI. Having an AI platform to go and talk about in front of other AI enterprise customers like Dell and so forth, this would be a big deal for them.
It would be. And it's pressuring both stocks today, particularly ServiceNow. $7 billion would be the biggest they've ever spent. Bloomberg's Ryan Gould with all the reporting across quite the wave of M&A. It's going to be a big blockbuster 2025 if you're looking at the numbers. But it's also a blockbuster day, it seems, for Tesla. Quick check on the markets here. And Tesla is your lead performer in terms of up 4.3%, in many ways driving it to potentially a new record high. At the moment, it's the biggest move since December 2024. And 1 point, if we hit 481.76, we could be the highest since June, on record for the company. So keep an eye on Tesla as it continues to outperform in the Magnificent Seven names. But that does it for this edition of Bloomberg Tech. Do not forget to check out our podcast. You can find it on the terminal, as well as online on Apple, Spotify, and iHeart. We are here throughout the build-up of the last trading week, full trading week, where we still question some of the AI valuations. Tune in throughout. I'm live from London today, back in New York tomorrow. This is Bloomberg Tech.